morning, everybody. This is not early morning crypto talk, afternoon crypto talk for most people. Go ahead, type in the chat box where you're listening in from. I see Peter from New Jersey, Jacqueline Briggs, St. Petersburg, Florida. Brian Roberts, Maryland. Reginald Allman, everywhere. Jeanette, Sweden. Brenda Fogel, South Orange, New Jersey. My cousin Marnita from Colorado. Ken Alexander from Houston. As a disclaimer, I'm not a licensed financial advisor to be giving financial advice. I read the news, give my opinion, share suggestions, and it is up to you to make an informed, intelligent decision on which direction you want to move into. There are 4 rules I live by in the crypto space to have success. Rule number 1, education is key. Education is everything. Rule number 2, never invest money you cannot afford to lose. Rule number 3, always get a return on investment back as fast as possible. And rule number 4, where do you see yourself in 3 months, 6 months, a year from now? What are you willing to do to make that happen? Make a decision, take action, stay focused, do not get distracted. Now, following these rules is not going to guarantee you success, but it will at least minimize your risk. And that, ladies and gentlemen, is the most that we can ask for. All right, so let's go ahead and kick things off and get started here. First, we're going to look at the market. Now, I said I didn't do a crypto talk yesterday. Things just got so busy. We had a special announcement from our CEO. Then my phone never stopped ringing after that. So I wanted to cover an article that's called talking about the great monetary inflation. And it's long, so that's the only article I wanted to cover in one crypto talk. So that's what we're going to cover today. But let's see what the market is at. $263 billion. And yeah, I know, Brian, I'm playing around with a new feature I figured out, and I'm just testing it on you guys to get the right volume and the ability to play the music so it's clear and doesn't sound all muffled. So give me some time, give me some practice, and I'll have that smoothed out so I can go back and listen to this recording and I can make the necessary adjustments. It's only my second time doing it that way. So yeah, we'll get there. So anyways, market cap's at $263 billion. It is up 4% over the last 24 hours. Bitcoin price is at $9,649. It actually reached, I think, 98 or 9,900. It came down just a little bit. It is up 6.2% over the last 24 hours. We're seeing a slow reversal within the last hour. Let's see, Tether is looking at in the negative still. So we'll see if this will still bounce around this $9,600 mark. So let's go to the article. This is done May 2020 BVI letter macro outlook by investor Paul Tudor Jones. Paul Tudor Jones is a billionaire. So I'm paying attention to what he has to say and his insights on the market. So this is called the Great Monetary Inflation. So let's get going. Again, I don't know how long this might take me. It might take me less than 30 minutes. COVID-19 is a one-of-a-kind virus that has triggered a one-of-a-kind policy response globally. The depth and magnitude of the economic drop-off took modern monetary theory, or the direct monetization of massive fiscal spending, from the theoretical to practice without any debate. It has happened globally with such speed that even a market veteran like myself was left speechless. Just since February, a global total of $3.9 trillion, 6.6% of global GDP, has been magically created. Got to understand that, how big that is. People that, oh, Bitcoin is made out of thin air. That's what President Trump said. It's just made up. It's just made out of thin air. It's worthless. But we've got 6.6% of the global GDP was just magically created through quantitative easing. We are witnessing. We are living through we're not reading history. You know, it's one thing when you go through history class, you're reading about the Great Depression. But what if you lived through it? I have a 96-year-old grandmother. She lived through it. And I asked her, I think I was in the early 90s, I was like a freshman in high school, I remember asking her questions. And I asked her, I was like, Grandma, what was it like, living through the Great Depression? And at that point, she was living in Shreveport, Louisiana. You guys see my cousin Marnita that's on here. Her grandmother and my grandmother are sisters. And we got a big family. It's like 11 of them, brothers and sisters. And then think of all the kids they had. And then all the kids they had, my generation. Well, I've got a huge family. But that side of my family started in Shreveport, Louisiana. And they had their own piece of land that they lived on. And they farmed on that land. My grandma is very good, and all her sisters know how to grow food. I remember growing up, and always we had our vegetables came from Grandma's garden. And then when my grandma went to live with my parents, Marnita's grandmother went to live with my cousin Robert in Vegas. They all still had gardens. My Aunt Nanny, she still got her garden. And so she said to me at that time, because of, you live in the Deep South in the 20s. She was born in 1923. So the Great Depression happened in the 30s. So she was a kid. And we're not that far removed from slavery, 1867. My grandmother's grandfather was the firstborn free. So it's not like it was that long ago. So she said that because of Jim Crow and the racism during those early days, that they weren't allowed to work or shop in the main cities where all the white people were. And if they did, they had, they had to go through the back door and things like that. But they weren't allowed to shop at some of those stores. So they had to grow, and they didn't have enough money to shop anyway. So they grew their own food. They were self-sufficient. And she said when the Great Depression happened, to them, they were like, what depression? It didn't change their lives. In fact, they were still surviving. And she said that the town folk would come up to their farms and buy food from them. Go figure how that worked. But it's different depending, ask your ancestors. What was life like living through the Great Depression, the Great Dust Bowl? Because a lot of things that happened during that time, that was a domino effect, not just the economy. But when the economy goes bad, then you have a ripple effect. We're experiencing that now. Because of COVID-19, everybody wants to shut down. I'm in Los Angeles, and they just announced this week that they want to shut us down for another 3 months. Well, there's consequences to that as well. Well, if you're not working, you're not making money. If you're not making money, you're not buying food. You're not putting money in the economy. More people lose jobs. There's consequences to everything. Of course, the number one goal right now is we got to save lives. That comes first before everything else. But there's consequences. And so we are right now, our future generations are going to they're going to read about this time, this era. But we are witnessing it. They didn't call it the Great Depression back then. The people that were alive in the 30s, they didn't call it the Great Depression. We call it that now. But we're already calling this the Great Monetary Inflation, an unprecedented expansion of every form of money, unlike anything the developed world has ever seen. Another thing that's very unique about this, it's not just the United States, it's not just China, it is the entire world. Global debt was very elevated entering the pandemic. So we were already at the brink. And just so I have not read this article. The only reason why I'm doing this Facebook Live is because it forces me to read the article. I can be a little bit lazy and distracted. If I was just reading this by myself, I might get through 2 paragraphs and then I'm off to something else because the phone might ring, my kid's doing something. So this is how I learn. I gotta hold myself accountable. So by making myself go live, I'm able to do it. So just so you guys know, so when I read things like a lawyer does. I don't just read, I read to understand. So I may pause in certain points and I might put out my thought process at the same time. So I'm thinking out loud. So global debt was very elevated entering the pandemic. And this monetary expansion is funding additional large debt creation. For now, without provoking the disciplining response of rising market yields. So far, the result has been asset price reflation. That's a word I'm not too familiar with. Asset price reflation. A large demand shortfall will prevent goods and services inflation from rising in the short term. The question is whether that will be the case in the long term with a central bank whose central focus will be repairing the worst employment crisis since the Great Depression. So in other words, what he's saying is that with this 6.6% increase in money overnight, we're not going to see an immediate impact, meaning we're not going to see grocery store milk all of a sudden shoot sky high next week. But long term, we're going to see the impact of this. One thing is for sure, there will be many assets that will move as a result of this money creation. So what is an investor to do? Traditional hedges like gold have done well, and we expect investors to continue to seek refuge in this safe asset. One thing I have learned over time is the best thing to do is let market price action guide your decision making and then try to understand the fundamentals as they become more evident and comprehensible. Okay, in other words, what he's saying there, don't let your emotions take over. Don't let your politics take over. This is the one thing that has me disturbed during this whole coronavirus thing, is that it seems that people are letting their politics decide how we should respond to this. Forget about anything that has to do with science. It's, are you a Democrat or are you a Republican? And the way the line is now being drawn, if you're a Democrat, you're all for, oh yeah, we need to keep things closed down until this thing blows over. If you're a Republican, you're looking at this from the standpoint, if you shut things down, the economy's not moving forward, and now you're infringing on our constitutional rights. We're giving up our freedoms. So depending on the spectrum that you're looking at, and both are right. It's not about one is right or wrong. Let me go back. I just made this post this morning, and this is what people that don't understand, people are emotional. You believe that your version of reality is the right and only version. You see this right here? This person sees a 6, this person sees a 9, and they're both right, depending on your perspective. Whenever I debate and I make comments, I'm always looking at both sides. I may have my own belief, but I still make it a point to understand the other side. And I was taught in debate class, know the other side's point of view better than they do. Make sure you can argue their point of view better than them. That's why I always make my point to be as objective as possible. So let me go back. That's my only concern now, is people are emotional on this. So what he's saying is, lose my spot. A large demand or shortfall will prevent goods and services from rising. Okay, global debt was very elevated entering the pandemic, and this monetary expansion is funding additional large debt creation for now. without provoking the disciplining response of rising market yields. So far, the result has been asset price reflation. A large demand shortfall will prevent goods and services inflation from rising in the short term. The question is whether that will be the case in the long term. One thing is for sure, there will be many assets that will move as a result of this money creation. But what is an investor to do? Well, one thing I have learned over time is the best thing to do is to let market price guide your decision making and then try to understand why it's happening as they become more evident and comprehensible. Quite often, how the markets respond will be at odds with your priors. So it's saying is what might happen is you're going to be challenged. This is the problem I have with Peter Schiff, the gold bug guy who believes is gold, only gold, everything gold, nothing but gold. And he made a bet back in 2011 and has been proven wrong, badly wrong. But even though he's been proven wrong, he still, because of his own personal belief, is still pushing, oh, gold's still better than Bitcoin. Dude, it outperformed, Bitcoin outperformed gold tenfold over the last decade. By far, it's not even close. But he refuses to admit that because it goes against his own personal belief. Isn't that how we are with religion? Aren't we the same way with politics? If it goes against your personal belief, even if true, you will not believe it, and you will find ways to discredit it, to make it so. I remember back in high school, I was in college, and there was a Clinton was president at the time. And you remember the whole Monica Lewinsky thing, and the critics against Clinton at the time, because Al Gore was trying to push, and so was Hillary, a health care bill. And it didn't pass because at that time the Republicans controlled the House and the Democrats controlled the Senate. I think it's how it was back then. That's why Clinton, he was impeached, but he wasn't removed from office, similar to what happened with Donald Trump. The Democrats for Trump controlled the House and the Republicans controlled the Senate. So while he was impeached in the House, the Senate didn't confirm it. So same thing happened with Clinton. But they tried to pass a health care bill. The thing about it is that health care bill was written up by Republicans. Mitt Romney was a senator. This is before he ran for president. And it was running in Republican states. But when a Democrat tried to put it forth, the Republicans shot it down. It's like they shot down their own bill. And they did an experiment. And the critics of Clinton, they said, okay, who said this? And they thought that Clinton said it, they were against it. But when it was shown that, no, Bush, Daddy Bush is the one who actually, and Ronald Reagan is the one who actually said it. They were like, oh, well, yeah, okay, it's okay when Reagan says it, but if Clinton says it, it's not true. Same thing right now. If Trump says something, those who are against Trump are going to be against anything that comes out of his mouth. But if Obama said the same exact thing, then those that are against Trump were all for it. You guys understand what I'm saying here? I'm being objective here. It's not one or the other. I'm just proving a point. And this happens when it comes to investing. If something's taking place that is not with your current belief, you're acting emotional, you're going to lose. So he's saying here, keep that out of it. Try to understand the fundamentals, even if it's at odds with your priors. But remember, the P&L always wins in the long run. With that in mind, in a world that craves new safe havens, there may be a growing role for Bitcoin. I might have to use this as a quote. Just that right there. Debt addiction. What is apparent to all is the global ramp up in debt from every sector to deal with the economic downturn. In addition to debt ratios increasing by virtue of a large numerator, such ratios will also be buoyed by a falling denominator. It may take more than 2 years to bring nominal GDP back to its pre-shock level. So he's saying 2 years from now. You guys ready for that? 2022. The Congressional Budget Office, for example, projects the U.S. government debt ratio to reach a new historic high next year, above the World War II peak. Corporate debt is also rising briskly to record levels as firms draw down revolving credit lines to self-fund cash flow shortfalls. At this pace, it is not inconceivable that the economy-wide debt ratio may increase by 50%. You've got to be kidding me. 50% of GDP over the next year and a half? If we go back to January 2019, you know what the biggest debate was at that time? Was it the border wall? $5 billion for the border wall. And Congress was acting like, we can't find $5 billion. The economy will go broke if we give Trump $5 billion. We're now talking about trillions that has already been passed and trillions more that's going to be passed. It's like, can we go back to the good old days where $5 billion would seem like a lot? Money printing is a hard habit to kick. Central banks are on the hook to help fund this debt increase. Since the end of February, the Fed's balance sheet has already grown by 60% and is on track to more than double by the end of the year. Even two QE novice central banks have unleashed their printing presses. The Bank of Canada has already tripled its balance sheet, and the Reserve Bank of Australia has allowed its balance sheet to increase by 43%. The counterpart of this rapid central bank balance sheet expansion has been a sharp increase in monetary aggregates. In the last weekly release of the Fed's money stock data, M2 rose 18.5% over a year ago, an unprecedented pace of growth in the history of the Weekly Times series starting from 1981. It is likely that the annual growth in M2 will continue to increase to somewhere between 20 to 40% by year end. We got these estimates on M2 from a few of the dinosaurs who still work on Wall Street. Rarely have we ever seen so many economists dismissive of an economic metric than when we asked about their notion on this record M2 growth and its meaning. The last time M2 grew at such a high pace was during World War II, when the annual M2 growth peaked at almost 27%. But monetary expansion alone is not sufficient to generate inflation. The context is very important too. Take Japan, the poster child of debt deflation. Arguably, this is a case where monetary financing of the deficit has been ineffective. But Japan has already in a prolonged deflationary spiral that had unanchored inflation expectations when this policy was unleashed in full. In any event, since 1999, their M2 never grew by more than 5% a year. A hobbled banking system focused on healing from a prolonged banking crisis had probably a lot to do with this. In the U.S., it could be also argued that a large deficit combined with massive money printing were ineffectual at stoking inflation in the aftermath of the global financial crisis. Again, context matters, and the post-pandemic recovery may be different from the GFC aftermath. First, an austerity movement similar to the one that swept the Tea Party to prominence in the 2010 U.S. midterm elections is very unlikely to emerge. The opposite forces are at play today as growing income inequality breeds populism. Second, the bank-centric GFC induced a one-time paradigm shift in banks' preference for liquidity, later enforced through regulatory changes. As a result, only a small share of the Fed's massive injection of high-powered money was relent in the banking system. M2 never grew by more than 10% a year, even after subsequent rounds of large-scale asset purchases by the Fed. Effectively, banks' preference for liquidity and the need to rebuild their capital cushions quashed the money multiplier. While the multiplier has recently started to fall, in a crisis, banks are wary to lend to potentially insolvent borrowers and, in fact, start building provisions for loan losses. This time, banks entered the crisis in a stronger footing, and policy is more squarely aimed at putting liquidity directly in the hands of businesses and households, shielding to some extent banks from losses. As such, the chance of a large fall in the multiplier as seen in the aftermath of the GFC is now smaller. Plus, the Fed's elimination of the reserve requirements means that the theoretical money multiplier is now infinite. In other words, what they're saying here is, even though all this new money that's flowing in is not going in the hands of the population, it's going in the hands of the banks and the businesses, with the hope that the banks and the businesses will lend more money out to the population, will invest more and build more businesses to hire more workers. But the opposite is happening. The banks and businesses are holding the cash. They're hoarding it to have a cushion. And it's the Ronald Reagan had the trickle-down approach, and this is the debate going on in Congress right now. Should we give the money directly to the people, or should we give it to the businesses? The Republicans say if you give it to the businesses, it's going to trickle down into the people. And now, if the businesses are surviving, they're going to hire more people. That means people are being able to have a paycheck. That means when people have a paycheck, they can go buy into the economy. That boosts the entire economy. That's the Republican standpoint. The Democrats are saying, well, it's not getting to the people. The banks and the businesses are hoarding the money. They're paying off their own debts. They're not hiring. They're not growing. They're not giving out loans. It's not trickling down. Therefore, if you give the money directly to the people will go out there and use it to spend. So they're spending money in the businesses. They're buying food. They're buying groceries. Or what people got their stimulus check, they ran to Walmart and bought freaking flat screen TVs when they should be buying food. But hey, free market, right? Do whatever you want with your money. So it depends on what side you stand on. Here's the deal. Both are right. Yes, it's possible. Both are correct. So what he's saying here, I like his approach. He's saying it doesn't matter my beliefs. I'm only looking at the results. Milton Friedman famously stated that inflation is always and everywhere a monetary phenomenon that arises from a more rapid expansion in the quantity of money than in total output. And while the relationship between inflation and M2 growth in excess of real output growth has not been stable over short horizons, it seems to hold over longer horizons. There are only a few times in history when M2 growth exceeded real output growth over a 5-year span by the same or a faster pace than is currently the case. The inflationary periods of the 1970s and 80s and the late 1940s. But remember, it is reasonable to expect inflation to first fall in the coming months, given the large contraction in demand relative to supply. So he's saying we're months away from huge inflation. The issue is whether a large monetary overhang in the recovery phase will eventually stoke consumer price inflation. To answer this question, we need to ask, how reasonable is it to expect that in the recovery phase, the Fed will be able to deliver an increase in interest rates of a magnitude sufficient to suck back? Remember, right now, they're talking about the rates, interest rates is in the negative or flat for the first time ever. Japan's been doing negative for a while. But at some point, the Fed's going to need to put and increase the interest rates so they make a profit and pay off the debt. So when they start to do that, what effect will that have on the economy? The current Fed leadership has made it a centerpiece of its new monetary policy framework to do whatever it takes to overshoot the inflation target in the recovery phase. This is a risky strategy. If the Phillips curve is truly flat, it requires a large increase in interest rates to bring inflation under control. But a more levered economy is also one that does not digest interest rate increases well. So when the time for liftoff finally occurs, any hiking cycle is likely to be delayed and unambitious. In other words, they're saying people want to see the profits. But the moment you start to increase the interest rate, you're eating up the profits. So you're delaying that rocket ship. Furthermore, the risk of a complicit, politically appointed, interesting you said that, the risk of a complicit, politically appointed central bank chairman cannot be easily dismissed, given that central bank independence is no longer a sacred cow. In other words, he's saying that politics will interfere on what should actually be good. That's one of those unknown factors. They're not going to look at what the market is saying we should do. It's going to be all politically driven. High debt accommodated by money printing is difficult to banish. Inflation expectations could one day respond to this reality. It is the risk of physical dominance that makes the current GMI potentially inflationary during the next cycling upswing. After all, fiscal dominance was a key reason for inflation to flare up in the late 1930s and the 1940s, when the Fed was strong-armed to keep rates low and to monetize Treasury debt issuance well beyond the economic recovery phase. There are other reinforcing considerations to fear a resurgence of inflation down the line. The pandemic has exposed the vulnerability inherent in global interdependence and stoked tensions between the U.S. and China. There may come a tipping point when a breakdown in global supply chains spills over to goods prices, undoing 2 decades of disinflation attributable to globalization. So 2 decades. We're going back to 2 decades ago was 1999. Wow. Or actually 2000 was 2 decades ago. 2 decades ago was 2000? My wife's shaking her head right now, getting old. You guys remember Y2K? Remember that was the big boogeyman of the era? That was 2 decades ago. 9/11 was almost 2 decades ago. I remember my aunt was right. The older you get, the faster time seems to go by. Wow. So with this type of monetary growth as a backdrop, here is one way to navigate these extraordinary times and policy actions. Below is a list of inflation hedges, rank ordered in what we call the inflation race. While some of this list will track inflation in the classic sense, other instruments have been added to pick up the assets that will respond best to an acceleration in monetary growth. Not just consumer goods and service price inflation, so it includes a host of assets that at one time or another have worked well in inflationary periods. Number one, gold, a 2,500-year store of value. 2, the yield curve, historically a great defense against stagflation or a central bank intent on inflating. For our purposes, we use the long 2-year notes and short 30-year bonds. Number 3, NASDAQ 100. The events of the last decade have shown that quantitative easing can rapidly leak into equity markets. Number 4, Bitcoin. There is a lengthy discussion of this below. That's what I can't wait to get to. Number 5, U.S. cyclicals, long and U.S. defensive short, a pure goods inflation play historically. Number 6, AUD-JPY, long commodity exporter and short commodity importer. Number 7, TIPS, Treasury inflation protected securities. That is indexed to CPI to protect against inflation. Number 8, GSCI, Goldman Sachs Commodity Index, a basket of 24 commodities that reflects underlying global economic growth. And number 9, JPM, Emerging Market Currency Index. Historically, when global growth is high and inflationary pressures are building, emerging market currencies have done quite well. Now it would be wonderful if we knew ex ante which horse to bet on. The goal, of course, is to be invested in the fastest horses over the duration of the ride. And to help monitor this, we review the horse race over the short, intermediate, and long term by averaging price performance over such periods. Okay, so in other words, understand, this is a billionaire who wrote this. I always talk about the river of money, that the rich are in the middle of the river with yachts and oil tankers, and they're fishing the biggest fish. And the fish is what money is. While all the poor people are on the shorelines with their little fishing poles, and they can only go so far into the river. But what happens when the river changes course? When it first starts to change course, the very wealthy deny that it's taking place because they like the status quo because it benefits them. But there comes a time when they realize it doesn't matter what they believe. The river's changing course. So they just pull up anchor and they flow in the direction of the new river, while all the broke people are still on the shores, now trying to fish in an empty river, wondering where did the money go? This is exactly what he's doing right here. He says, look at this, the goal, of course, because billionaires realize this, it's common sense, is to be invested in the fastest horse. Don't invest in something just because that's your philosophy. It's worked in the past. It doesn't mean it's going to work in the future. That's Peter Schiff, still holding on to gold. Now, gold's not bad. It's just not the best performer. So, and to help monitor this, let's look at what he's reviewing. What is the fastest horses? So this provides a snapshot such as shown below, which was taken on May 6th. We have ranked, what's today? May 13th, okay, last week. We have rank ordered the instruments below by averaging the 1 week, 1 month, 3 month, and 12-month returns. We show the performance and volatility, adjusted returns, not in nominal returns. So think of each unit as approximately a day average trading range. So gold under the last year column has gone up about 26 daily ranges, which also equates to about $406 from 1280 to 1686. So that's what gold has done. So you've got gold, yield curve, NASDAQ, Bitcoin. Look at Bitcoin right up there. Bitcoin, U.S. equity, AUD, JPY, JPM, TIPS, and GSCI. From the table, gold is the clear winner of the inflation race at this time. In second place is the long U.S. 2s 30s yield curve. In third place is the NASDAQ 100. Remember, this GMI is going to show up somewhere, so why not stocks? And in fourth place, it is Bitcoin. Yes, Bitcoin. It did trade $18 billion of volume on the last day of April and is an emerging asset class by any metric. You have to understand how huge this is. Bitcoin is only 11 years old, and it's broken into this group. In other words, it's now getting on the radar screen of the billionaires. Now, there's only going to be 21 million Bitcoins ever in existence, and the last one will be mined in 2140. There are more millionaires and billionaires on the planet than there are Bitcoin, and they can afford it. Many of you say, I can't afford to pay $9,600 for one Bitcoin right now. They can. That's pocket change to them. And when they figure it out, if every single one of them wants to own at least one Bitcoin, there's not enough to go around. So why this is important is it's now on their radar screen. And they do what he just said. The goal, of course, is to be invested in the fastest horses. So when the billionaires start looking at the market, they start looking at the charts, they see Bitcoin up there, they're going to start to invest in it. And when there's more demand than there is supply, what happens to the price? This is freaking common sense. The problem is the average American only reads books at an 8th grade level, 50% of Americans. So what percentage of them are even financially literate? What percentage of them would even read an article like this that I'm reading right now, let alone understand what it's saying? If you're still listening and you're comprehending what's being said, you are putting yourself ahead of the vast majority of people if you act on it. And let me continue here. This is why this is important. This is why I'm doing this live, because I'm forcing myself to read this. So, of course, bringing up the bottom with a hugely damaging return, negative 10 daily ranges, also equivalent to negative 46% in the trailing 12 months, is the Goldman Sachs Commodity Index. This index has been pummeled due to the crash in oil prices as producers are at war to preserve their market share and stay afloat. I was just telling my wife the other day, I've only gotten gas once in the past. It's been 2 weeks since I got gas, and before that, it was about a month. And my gas tank is still way above, more than half full. You see, I saw the chart on the news, all those oil tankers in the world that are just sitting out there in the ocean because there's no demand for gas. So that's getting pummeled. One thing that piqued my interest from this list of assets, and that one day might be brought to prominence by the GMI, is Bitcoin. Stop right there. Think about what I just said. The billionaires and millionaires, when they figure it out, the rocket ship takes off. So now he's looking at his charts, and this piqued his interest. Bitcoin, truth in advertising. I'm not a hard money nor a crypto nut. I am not a millennial investing in cryptocurrency, which is very popular in that generation, but a baby boomer who wants to capture the opportunity set while protecting my capital in ever-changing environments. That is huge. I made that as a quote of the day the other day. That is huge. He's not going to be the only one. One way to do that is to make sure I am invested in the instruments that respond first to the massive increases in global money. And given that Bitcoin has positive returns over the most recent time frames, a deeper dive into it is warranted. Translation. Hey, I better pay attention to this thing. It's still making money in this environment. I did have some experience with it back in 2017, having a tiny amount in my personal account for fun. Amazingly, I doubled my money and got out near the top when it was apparent to any market technician we were blowing off. It is amazing how well one can trade when there is no leverage, no performance pressure, and no greed to intrude upon rational reflection. Again, he goes back to, he's not looking at this emotionally. Because when it doesn't count, we're all geniuses. He was just playing around, doubled his money. But the GMI caused me to revisit Bitcoin as an investable asset for the first time in 2.5 years. Like I tell everybody, we've got a short period of time now. We've got to the end of the year. The halving's already taken place. Now we're looking at the next 6 months. You're going to be able to tell your kids and grandchildren, you remember when Bitcoin was less than $10,000 a coin. And they're going to say, did you get any? No, I thought it was too expensive back then. And Bitcoin's worth more than $100,000 a coin. It falls into the category of a store of value. Now understand, that is not what Bitcoin was designed to be. It was not designed to be a store of value. That is how people are using it. And it has the added bonus of being semi-transactional in nature. The average Bitcoin transaction takes around 60 minutes to complete, which makes it near money. It must compete with other stores of value, such as financial assets, gold, and fiat currency, and less liquid ones such as art, precious stones, and land. The question facing every investor is, what will the winner be in 10 years' time? So now they're looking at the next 10 years here. We are in the mind of billionaires right now. You want to make money, you want to be in a better position in the next 10 years, follow what they are already doing, how they think. So he's already, okay, so what's going to be the winner in the next 10 years? He's a baby boomer. What are the age of the baby boomers right now? In their 60s and 70s? So he's already looking, okay, yeah, all right, 10 years from now, not just tomorrow. At the end of the day, the best profit maximizing strategy is to own the fastest horse. Just own the best performer and not get wed to an intellectual side that might leave you weeping in the performance dust because you thought you were smarter than the market. Stop right there. I got to do this. I'm going to pull up a self-proclaimed genius named Peter Schiff, the gold bug. And I'm going to play something. So this is not the traditional crypto talk. I'm able to take my time on this. Yeah, give me the gold video. Peter Schiff, here it is. This is only less than a minute long video. No, not that one. That's when I did a crypto talk on Peter Schiff. Really? I can't find this? Let's see. There it is, 35 seconds. Yeah, here it is. This is important. I'm proving a point. Take a listen.
If I'm gonna put my wealth, I'm gonna take $10,000 and store them in Bitcoms. How do I know that a year or two from now anybody is going to accept them for anything? What if it's a fad and nobody wants them? See, the thing with gold is gold has value all by itself. If I don't have to be able to spend it, I can melt it down. I can make it into jewelry. I can use it in electronics. It has all sorts of properties that make gold intrinsically value all by itself. Right? It doesn't have to be traded for another product. It can be used.
Stop right there. This was an example. If you put the $10,000 in gold in 2011, by the end of 2019, your value will be $9,854. But if you put it into Bitcoin in 2011, your value will be $4.1 million. This is a classic example of what this billionaire is talking about. Put your ego aside, put your current beliefs aside, and just look at the performance. Is there a difference between $9,854 and $4.1 billion? It's common sense. All right, let's go back. You guys are awfully quiet. Either I'm putting you to sleep or this is making sense. Either way, it doesn't matter to me. Look at this. So what's going to be the biggest winner in the next 10 years' time? So I'm going to read this part again. At the end of the day, the best profit maximizing strategy is to own the fastest horse. Just own the best performer and not get wed to an intellectual side that might leave you weeping in the performance dust because you thought you were smarter than the market. If I am forced to forecast, it's interesting he said that. If I'm forced to forecast, my bet is it will be Bitcoin. A store of value is anything that holds its purchasing power in the future. It is completely a function of people's perception of its worth. Even tulips at one time were considered a store of value. Financial assets comprise the largest store of wealth in the world, as they generally have the added advantage of providing yield, which helps offset the impact of inflation. Gold has survived the test of time, although a rational person could ask, why gold over any of the other 118 elements? Fiat currency is backed by the full faith and credit of the people of that country, although that promise has high variability, as history has shown. And the newest entrant is Bitcoin, which seems to have emerged from the crypto war of 2017 as the clear winner, with a market cap 10 times that of its closest competitor. So how do these stores of value stack up against each other? We graded stores of value on 4 characteristics. Number 1, purchasing power. How does this asset retain its value over time? Number 2, trustworthiness. How is it perceived through time and universally as a store of value? Number 3, liquidity. How quickly can the asset be monetized into a transactional currency? That's the biggest point right there. You can't do that with gold. And number 4, portability. Can you geographically move this asset if you had to for an unforeseen reason? Again, you can't do that with gold. For the purpose, and of course, there's some gold people that listen to me. They want to shut it down, but it's fact. I'm not against gold at all. So I want to make that a point. All the carrot bars people are going to go nuts. So for the purpose of this exercise, real estate, art, and precious stones have been excluded, as they will fall to the bottom of the ranking automatically because of generally poor liquidity and portability characteristics. Let's focus on financial assets, fiat currency, gold, and now Bitcoin. To offer perspective, Table 2 shows the value of these assets at the present time. It is an important table, which I will come back to. Okay, so let's look at the table. So number 1, global financial assets, stocks, and credit. So in the $1 billion, $266 billion. Number 2, cash, $39 billion. This is global, 39 trillion. Global financial assets, 266 trillion. Total value above ground gold, 9 trillion. And total market cap of Bitcoin, 186 billion. So gold has a huge head start. We're talking about almost $10 trillion cap of gold that has already been mined. Okay? Bitcoin's only at 186 billion. Remember, the challenge here is to understand which store of value will be the winner in the next 10 years. So if you are that carrot bar person and you're all in gold, do you believe that gold is going to be the winner in the next 10 years? You got to take emotion out of it. Take your wed to a belief out of it and just look at performance. I do not think so. Does that mean I believe gold is going to go away? Absolutely not. Gold will still be an important store of value forever, no matter what happens. Gold's been here since the beginning of time, and it will be here at the end of time. But when I'm looking at the next 10 years, Bitcoin is going to outperform it. So that was my opinion. Let's see what he has to say. The first thing is to score the 4 assets against the 4 criteria laid out above. So I polled my research group to see what this team of informed persons thought. After discussion, we created a scoring system for a store of value with the maximum score being 100. We considered some categories more important than others, so we allocated 30% to the categories of purchasing power and trustworthiness, and 20% to each of liquidity and portability. Then we scored the 4 sets of assets above and came up with a composite and highly subjective value for each in Table 3 below. So here's Table 3, grading assets by their ability to store value. Financial assets, 71. Fiat cash, 54. Gold, 62. Bitcoin, 43. Before drawing broad conclusions, here were some of the more salient points in each category. When it came to purchasing power, everyone was a carry merchant arguing the only way to defeat inflation was with some type of yield, i.e. financial assets. This was particularly popular with the 30-something crowd who gave financial assets the highest score across the board. I reminded them that in the 1970s, inflation was near double digits at times, and the road to hell was paved with carry. In fact, virtually all financial assets were shunned because the yield could not keep up with inflation in many cases like now. So what he's saying is these millennials, the young crowd, they weren't alive in the beginning in the 70s to experience this. So I also made the case for owning Bitcoin, the quintessence of scarcity premium. It is literally the only large tradable asset in the world that has a known fixed maximum supply. By its design, the total quantity of Bitcoins, including those not yet mined, cannot exceed 21 million. Approximately 18.5 million Bitcoins have already been mined, leaving about 10% remaining. On May 12th, Bitcoin's mining reward, the pace at which the supply of Bitcoin is increased, will for the third time be halved, falling from 12.5 to 6.25 Bitcoins per block of transaction added to the Bitcoin. Future halvings will likely occur approximately every 4 years, consistent with Bitcoin's design, thus continuing to slow the rate of supply increase and causing some to estimate that the last available Bitcoin will not be mined for another 100 plus years. This brilliant feature, interesting, this billionaire is calling this brilliant feature of Bitcoin was designed by the anonymous creator of Bitcoin to protect its integrity by making it increasingly near and dear, a concept alien to the current thinking of central banks and governments. The most surprising result of our research group poll was the score ascribed to fiat cash. It got a 0 almost across the board. The cry from the troops was, if something is by design going to depreciate 2% per year through inflation, why own it? So in other words, you're sitting on cash. Why would you keep cash in a savings account when you're losing money every year? That's what Robert Kiyosaki's been preaching for 20 years, 30 years. I don't put your money in a savings account that you're going to have for retirement. You're losing money every year. The next category we discussed in determining whether or not something was a good store of value was trustworthiness. No surprise here, Bitcoin got the lowest score because it is also the youngest entrant at 11 years of age. Someone mentioned that it has 60 million users in almost 200 countries, but that did nothing to sway people. Gold, as one would have guessed, scored first in this category, as it has stood the test of time for thousands of years, and it always will. Liquidity is one of those things that never matters until it does. Every 10 years, it seems, which is why we weighted only 2 to 3 of the value of purchasing power and trustworthiness. But as we have all probably experienced in the last 2 months, liquidity is hugely important when things go pear-shaped. It is reasonable to assume, given the number of bankruptcies we are about to witness, did you hear that? The number of bankruptcies we are about to witness, and the number of people who will be jobless and near poverty, that both companies and individuals will have a much higher preference for liquidity in the coming years. Cash scored the highest here, and rightly so. Financial assets are a mixed bag because some, like private equity and bespoke credit instruments, take forever to liquidate and often at severe discounts. Interestingly, Bitcoin is the only store of value that actually trades 24/7 in the entire world. Finally, there is portability. Like liquidity, it is not an issue until it is. Imagine a geographic upheaval where it be caused by war, an epidemic, or change in government that becomes hostile to with little or no transaction costs. Becomes hostile to holders of wealth. A great store of value can be seamlessly moved from one jurisdiction to another with little or no transaction costs. Cash is obviously good for that. Gold is okay but clunky. But of course, nothing beats Bitcoin, which can be stored on a smartphone, among other things, or other options. So that was the flavor behind some of the discussions that were had when scoring the suitability of each asset as a store of value. What was surprising to me was not that Bitcoin came in last, but that it scored as high as it did. Bitcoin had an overall score nearly 60% of that of financial assets, but has a market cap that is 1 to 1200th of that. It scores 60% of gold as a store of value, but has a market cap that is 1/60th of gold's outstanding value. Something appears wrong here. And my guess is it is the price of Bitcoin. The most compelling argument for owning Bitcoin is the coming digitization of currency everywhere, accelerated by COVID-19. This is important. Listen to this. Bull markets are built on an ever-expanding universe of buyers. Central to the price of Bitcoin is how many more or less owners of Bitcoin will there be beyond the 60 million who currently own it. The probable introduction of Facebook's Libra, whose value will be pegged to the US dollar and will not be a store of value in that sense, as well as China's DCEP, also tied to the yuan, will make virtual digital wallets a commonplace tool for the world. It will make the understanding, utility, and ease of ownership of Bitcoin a much more commonplace option than it is today. Owning Bitcoin is a great way to defend oneself against the GMI, given the current fact set. As Satoshi Nakamoto, the anonymous creator of Bitcoin, stated in an online forum around the time he launched Bitcoin, the root problem with conventional currency is all the trust that's required to make it work. The central bank must be trusted not to debase the currency, but the history of fiat currencies is full of breaches of that trust. I am not an advocate of Bitcoin's ownership in isolation, but do recognize its potential in a period when we have the most unorthodox economic policies in modern history. In other words, he's saying he's not an advocate of just owning Bitcoin and that's it. So we need to adapt our investment strategy. We have updated the Tudor BVI offering memoranda to disclose that we may trade Bitcoin futures for Tudor BVA. We have set the initial maximum exposure guideline for purchasing Bitcoin futures to a low single-digit exposure percentage of Tudor BVI's net assets, which seems proven. In other words, this is what I've been saying for 2 years. What market experts are advising their clients to do. If you've got a portfolio of more than $10 million, they're advising their clients to put 1% into Bitcoin, which means $100,000 worth. And this is what their reasoning is. If it doesn't work, it's not going to impact your portfolio. You just lost $100,000. But if it does what we think it's going to do over the next 10 years, that $100,000 will be worth more than $25 million, which is more than what your current portfolio is as a whole right now. So that's what he's saying here. Many of you know my fondness for analogs. Bitcoin reminds me of gold when I first got in the business in 1976. That's the year I was born, almost 44 years ago. Gold had just been productized as a futures instrument like Bitcoin recently. This is why it's important to know your history. And had enjoyed a heck of a bull market, almost tripling in price. It then corrected almost 50% in nearly 2 years, similar to Bitcoin's 28-month, 80% correction. You can see the similarities in the two charts below. Oh, wow. Oh, wow. Look at that. Here's gold, 1973 all the way to 78. Look at that. Here's Bitcoin, 2016 to 2020. It's almost identical. But in the case of gold, it was a tremendous buying opportunity as gold went on to more than quadruple past the prior highs. The red line in the chart below is where we might be in Bitcoin today. Oh, are you kidding me? Okay, just look at this. This is where he's saying where we are with Bitcoin today, where gold was between 77 and 78. And if it follows exactly what gold did, look at this jump. From the $100 to $200 million range market cap to $800 to $900 billion range. Do you understand? This is why this is buying season right now. This got me excited looking at this right here. Speaking of gold, in a low carry world, gold remains a very attractive hedge against the great monetary inflation and hedges against other risks in clouding the outlook, including a renewed flare-up in the China-U.S. relationship, where financial sanctions could eventually be used in a brute force decoupling. How far can gold rally from its current price? A simple metric based on the ratio of the value of gold above ground to global M1 suggests gold could rally to 2,400 before it reaches valuations consistent with the lowest of the last three peaks in this valuation metric, and 6,700 if we went back to the 1980 extremes. One thing is for sure, these are going to be incredibly interesting times. That's it. Those of you that might have come on late, you definitely want to go back to the beginning. I'm at a point now, I wish this could keep going. I'm soaking all this up. I want to learn more. But this is very, very interesting. And this is a billionaire's perspective. In other words, they're starting to wake up. They realize the river of money has changed course. And they're going to adapt to it. We still have, on the low-end spectrum, 6 months. On the high-end spectrum, about a year and 3 months. So short end, 6 months, long end, about 16 months. And things will never be the same again as far as this. It's like the internet explosion. But I like this, what he's saying here. This isn't done by opinions. He just did the math. Did the science, saw what gold did compared to what's going on right now. Do you want to get in Bitcoin right here, or do you want to get into Bitcoin over here? This is when the vast majority of people will be getting in on it. But those of you that get in on it here, your family's lives will never be the same again. All right, that is it for this special crypto talk. Only thing I have scheduled today, I did an international presentation earlier this morning. I've got another presentation tonight. It's going to be a short version of that, about 17 minutes long, 20 minutes long, tonight at 9 p.m. Eastern, 6 p.m. Pacific. If you are in a situation where you want to learn how to receive and accumulate Bitcoin, I don't buy Bitcoin. I haven't bought Bitcoin since 2016 and 17. I accumulate it because I receive it. I earn it. And Provis is absolutely right. Right now is the time for accumulation. My whole mind is, the only thing that kills me is the fact since I live on it, I've got to spend it, to live on it. But to be in a situation to accumulate as much as humanly possible. On the short term, make sure you own at least one whole Bitcoin and stash it away. The millionaires and billionaires will be paying you anything for it. All right, with that, hope you guys learned something new. As always, that is the point. See you all tonight. Bitcoin Brandon out. God bless. Bye-bye.